A woman had a retirement account. Inside it were shares of stock she had held for years. She had not logged in for a while. She had not moved the money. She did not need to. It was retirement savings. It was supposed to sit there. Her state government declared the account abandoned, took the shares, and sold them. She was not notified in a way she noticed. She found out later when she tried to access her own account and discovered it was empty. The state refunded her the money it had received when it sold her shares. But by the time she discovered what had happened, the stock had quadrupled in value. The shares the state sold for roughly $200,000 would have been worth close to $2 million. She lost approximately $1.8 million. Legally, to her own state government, the process that took her savings has a name. Almost no American knows it. It is called escheatment, and it is legal in every state in the country. This is the story of how American states quietly seize, sell, and spend the money their own citizens forget about. Escheatment is an old legal concept. Centuries ago, under English common law, when a person died with no heirs, their property reverted to the crown. The land could not simply sit ownerless. It escheated. It returned to the sovereign. In modern America, the concept was repurposed into something much broader. Every state now has an unclaimed property law. Under these laws, when a financial asset sits inactive for a defined period of time, the state can declare it abandoned and take custody of it. The assets covered are broad: dormant bank accounts, uncashed paychecks, forgotten security deposits, stocks and brokerage accounts, unclaimed insurance payouts, utility deposits, gift certificates in some states, contents of safe deposit boxes, and retirement accounts. The period of inactivity that triggers the seizure is called the dormancy period. It varies by state and by asset type. In many states, it is 5 years. In some, it is 3. For certain assets, even less. The clock does not require the account to be lost. It only requires it to be inactive. No logins, no transactions, no contact. A retirement account that a person deliberately leaves untouched to grow, exactly as they are told to do, can meet the definition of abandoned. The state does not have to prove the owner is gone. It only has to observe silence. Return to the woman whose account was taken. She was a former employee of Microsoft. Among her assets were 4,326 shares of company stock, held in an account tied to her time at the company. The state that took her shares was Delaware. Under Delaware law, after a period of inactivity, the shares were presumed abandoned. The state took custody of them. Then the state did something that most people do not realize is part of the process. It did not hold her shares, it sold them. 4 months after taking them, the state liquidated her stock and converted it to cash. The sale produced roughly $199,000. Over the following period, Microsoft stock rose sharply. It roughly quadrupled. Had the shares never been touched, they would have been worth close to $2 million by 2024. When the woman discovered what had happened and filed a claim to recover her property, the state returned what it was legally required to return: the cash value at the time of the sale, roughly $200,000. The difference, approximately $1.8 million, was gone. The appreciation belonged to no one she could sue. The shares had been sold years earlier by the state at a price she never agreed to. This is the part of escheatment that turns a temporary seizure into a permanent loss. When a state takes custody of stock, most states do not preserve it as stock. They sell it, often within months, and hold the cash. When the original owner comes to reclaim their property, they do not get their shares back. They get the cash the state received when it sold them. Any gain in value between the sale and the reclaim belongs to no one. Any dividends paid during that period are gone. If the stock rose, the owner absorbs the entire loss of the appreciation. If the state had simply held the shares, the owner would have recovered them intact. Because the state sold them, the owner recovers only a frozen snapshot of a past price. The consequence is that the timing of the seizure is everything. A person whose shares were taken and sold at a market low and who reclaims them after a market rise can lose the majority of their wealth, without any of it being classified as a taking. In law, they were made whole. They received the exact amount the state received. In reality, they lost a fortune. The state bears none of the market risk. The citizen bears all of it. If this is the kind of pattern you want to see exposed every Thursday, hit subscribe. There is a second penalty hidden inside the process. It involves retirement accounts specifically. When a state seizes a traditional retirement account, a 401k or an individual retirement account, and the funds are transferred out, the federal government does not treat the transfer as a theft or as a seizure or as an involuntary loss. It treats it as a withdrawal. Under rulings issued by the Internal Revenue Service, the escheatment of a traditional retirement account is a taxable distribution. The institution holding the account must withhold federal income tax before sending the balance to the state. The distribution is reported to the IRS on a tax form as income the account holder received. The account holder may never have touched the account, may never have authorized a withdrawal, may not even know the account was taken, but the tax record shows a distribution, and the tax obligation can follow. A person can owe income tax on retirement money that their state seized, that a financial institution liquidated, and that they never received a single dollar of. The seizure is treated for tax purposes as if the owner chose it. The question that explains why this system persists is a simple one. What does the state do with the money? In theory, unclaimed property is held in trust. The state is a custodian. The money remains claimable by its rightful owner forever in most states. On paper, it is not the state's money. In practice, most states do not hold the money aside. They deposit it into the general fund and spend it. The unclaimed property becomes a line of revenue, indistinguishable from taxes, used to fund schools, roads, salaries, and operations. The obligation to return it becomes a bookkeeping entry, a liability on a balance sheet against money that has already been spent. No state demonstrates this more clearly than Delaware. Delaware is a small state. It has fewer than 1 million residents, but it is the legal home of more than 60% of Fortune 500 companies, because its laws are favorable to incorporation. When a company holds unclaimed property and cannot identify the owner's home state, a legal rule sends that property to the company's state of incorporation. That state is very often Delaware. The result is that unclaimed property is one of Delaware's largest sources of revenue. In recent years, it has accounted for a substantial share of the state's entire budget, by some measures between 6 and 13%. It is consistently among the top 3 revenue sources for the state. Hundreds of millions of dollars per year flowing into the general fund from property that legally belongs to other people. A state does not shorten dormancy periods, sell seized assets quickly, or fight to keep unclaimed property by accident. It does so because the money funds the government. The incentive is not to reunite property with its owner. The incentive is to take custody of as much of it as possible, as fast as the law allows. Over the past several decades, states have made a series of quiet changes to their unclaimed property laws. The changes share a direction. Dormancy periods have been shortened. Assets that once had to sit inactive for 7 years now escheat in 5 or 3. The categories of property subject to escheatment have expanded. The notification requirements, the state's obligation to find and warn the owner before seizing their property, have often remained minimal. In many cases, the required notice is a letter to the last known address or a listing in a database the owner has no reason to check. If the owner has moved, the notice fails. The dormancy clock continues. The property is taken. This has not gone entirely unnoticed by the courts. In one federal case, a judge reviewing a state's escheatment practices wrote that the state's conduct shocked the conscience, that it operated as a game of, quote, gotcha, designed to take property through technicalities rather than to protect it. A justice of the United States Supreme Court, writing separately in another matter, warned that states shortening their dormancy periods while providing minimal notice raised serious constitutional concerns about due process. The right to be properly notified before the government takes what is yours. The warnings exist, the rulings exist, but the system has not changed. The money is too useful. Roughly 1 in 7 Americans has unclaimed property being held by a state right now. Tens of billions of dollars sit in state custody, legally belonging to citizens who in most cases have no idea it is there. Some of it is genuinely lost money, old deposits, forgotten accounts, checks never cashed. And the unclaimed property system does in fairness reunite some people with money they had written off. But the design of the system reveals its priorities. The dormancy periods are short and getting shorter. The notice is minimal. Seized stock is sold quickly, transferring all market risk to the citizen. Seized retirement accounts trigger a tax bill for a withdrawal the owner never made, and the money, rather than being held in trust, is spent, woven into the budget of the state so completely that returning it would mean finding the revenue somewhere else. The woman who lost $1.8 million did nothing wrong. She saved, she held. She left her retirement account alone, exactly as every financial advisor in America tells people to do. The silence that financial discipline produces was read by her state as abandonment. Escheatment is not a scandal in the sense of being illegal. It is the opposite. It is entirely legal. It is written into the statutes of every state. It operates in public, in daylight, under laws that anyone can read, and almost no one does. The state did not break the rules to take her savings. The state wrote the rules, and the rules were written so that the silence of a careful saver could become the property of the government.